Hello. In this part of this video, we are going to discuss about a very important part, which is investment, where we should invest, and even after making investment, we need to identify the performance of that tool, whether the investment which we are making is good or not. So we are going to discuss about how to evaluate the performance of investment avenue in which we are making investment. It can be a portfolio evaluation, or it can be known as mutual fund. Like, we are making investment in mutual fund because we cannot create a portfolio, as we cannot give whole day in maintaining our investment if we are making investment in shares, and if we are doing some other job, so we cannot give our full time in identifying the performance of stock. And that is why investment in mutual fund is one of the best tool, because mutual fund are the experts. Mutual fund advisors, mutual fund manager, they are expert in making investment, and they are giving professional benefit. They are giving advantage of making investment in bulk. So generally, as an individual, if we are not able to make our own portfolio, we should invest in mutual fund, because they create portfolio on our behalf. But at the same time, we need to identify the performance of this portfolio, how they are doing, and whether they are doing good as compared to peer, whether they are good as compared to benchmark. But what are the tools and how we can measure? So that we are going to discuss. First, we are going to discuss why evaluation is necessary, to check whether where to invest our hard-earned money, because the money which we are earning, we are saving our money, we are saving a single penny, and we create a bunch of money, and this hard bunch of money where we should invest, so that the investment is good, our fund should be safe. To check whether our money is invested are in proper investment avenue, as there are so many investment avenues. We can invest in gold, we can invest in mutual fund, we can invest in shares. So if we are investing in mutual fund, whether we have done a good job or not, to compare with peers and benchmark. The mutual fund in which we are investing, when we do the performance evaluation, we will make comparison with other mutual funds, or we will make comparison with its benchmark. Like, if it is CNX 100 mutual fund, that means all money of this mutual fund will be invested in CNX 100. So we will identify how CNX 100 is performing and how this mutual fund is performing. So we are going to make the comparison with it. To give ranking of our peers, of our investment with peers benchmark, and that is why evaluation is necessary. Now let us see one hypothetical mutual fund schemes, and how we can make its performance evaluation. Before we start, there are three measures of mutual fund evaluation. One is Sharpe Ratio, one is Treynor Ratio, one is Jenson Ratio. So we give ratio, we will find out the ratio of all three mutual fund and even its benchmark of Sharpe, Treynor and Jenson, and then we give ranking also, as compare with Sharpe ranking, Treynor ranking and Jenson ranking. According to Sharpe, which is first, second and third mutual fund; according to Treynor, which is first, second and third, which is Jenson. So let us see. There are three mutual funds. We have 1 lakh rupees, and we are going to think where we should invest. So one of our friend has suggested there are three mutual funds. One is X, Y, Z, and one is Nifty 50, or you can say market. So mutual fund X is giving 15% return in past years. This is the past performance. but its standard deviation is 20%. Its standard deviation is 20%. Beta of that mutual fund is 0.9. Now standard deviation means risk of mutual fund with respect to its own investment, and beta is a risk of mutual fund with respect to market. So beta is called systematic risk and this is called unsystematic risk. This can be avoided, this can be reduced with better fund managing ability, but this we cannot avoid. This is called market risk of mutual fund X with respect to the stock which they are taking and with respect to the market fluctuation. Similarly, mutual fund Y giving 17% return, its standard deviation is 24%, its own risk 24%, and its beta market risk is 1.1. Mutual fund Z is giving 19% past performance, its standard deviation is 27%, which is highest. Return is also highest, but risk is also highest. Its beta is also highest. And there is market, which is giving 16% return. Its standard deviation is 20%, and beta of market is always 1 because market is not having any risk with anybody else. So all this beta is risk with respect to market. So market with market is always 1. There is a risk-free rate available in market, that even if we are not investing, even if you keep in a government deposit, it gives you 10%, which is called risk-free rate. So our 1 lakh money, where we should invest, we will identify with the help of Sharpe, Treynor and Jenson. So let us see the first performance evaluation, which is Sharpe ratio. The formula of Sharpe ratio is portfolio return, which is called RP, minus risk-free rate. So it is known as risk premium, how much extra return you are generating by taking extra risk, divided by standard deviation of portfolio. So Sharpe ratio is identifying the extra return with respect to risk of portfolio, how much risk portfolio is taking and how much extra return portfolio is generating. So when we calculate for mutual fund X, mutual fund X portfolio return was 15 and standard deviation is 20 and market risk free rate is 10%. So there is 5% extra return mutual fund X can generate, but at the same time standard deviation, which is risk of mutual fund X, is 20. So Sharpe ratio comes to 0.25. This is 0.25. Now similarly we calculate for mutual fund Y, extra return, which is called risk premium, 7%, and the standard deviation of mutual fund Y is 24. So the Sharpe ratio of mutual fund Y is 0.292. So for X we had 0.25, for Y we have 0.292, and for Z we have 0.33, which is risk premium divided by standard deviation. For market it is 0.3 risk premium, market is giving 6% extra and market standard deviation was 20%. So the Sharpe ratio of market is 0.3. This is Sharpe index. At the end we will write all this ratio and we compare with Sharpe rank, Jenson rank and Treynor rank, and then we will identify according to performance evaluation which mutual fund is better. So now this is second ratio, which is Treynor. The formula is again same, RP minus RF, which is called portfolio return minus risk rate, which is extra return, divided by, now instead of standard deviation, now this time we will calculate as with respect to beta, how much extra risk with respect to market and how much extra return portfolio is generating. So for portfolio X, extra return which was generating was 5 and the beta was 0.9. So mutual fund X Treynor ratio is 5.56. For mutual fund Y, which is 7%, 17 minus 10%, which is risk-free rate, 7% extra return it is generating, and divided by 1.1, which is beta. So the mutual fund Y Treynor ratio is 6.36, and for mutual fund Z, which is extra return which is generating 19 minus risk-free rate divided by its volatility 1.2, it comes to 7.5. And for market it is 6, as 6 is extra return and beta of market is always 1, so this is 6. So this is Sharpe and Treynor. Now the third performance evaluation is through Jenson, which is called Jenson's alpha, which is also known as extra return as compared to CAPM. Now there is a capital asset pricing model. Capital asset pricing model means risk-free rate plus beta of share or portfolio multiplied by risk premium, which is RM minus RF. So according to CAPM model, which is capital asset pricing model, this should be the return. The company or portfolio should provide this much. For example, when we calculate for X, it should be 10, but if X is giving more than 10, it is generating extra return. So Jenson's alpha is called how much extra portfolio is generating, how much extra return portfolio is generating, is giving you. So this is called standard return, and this is actual return. So actual minus as compared to standard, what is Jenson's alpha? So for portfolio X, portfolio X is giving 15%, but as compared to the risk involved in mutual fund X, the return should be 15.4. That means as per Jenson's alpha, mutual fund X is giving minus 0.4% return. So we should not invest in mutual fund X. For mutual fund Y, it is giving 17%, and as compared to standard risk, as compared to the risk which mutual fund Y is involved having in it, it should give 16.6, but it is giving more than this. It is giving 0.4 extra. So as per Jenson's alpha, mutual fund Y is giving positive 0.4% return. And for mutual fund Z, 19% it is actually giving, and as compared to standard, it should give only 17.2. So that means it gives 1.8% return extra. So this is called standard, which is actually what they are giving, and this is standard, which they should give as compared to the risk it involves. So mutual fund Z is giving 1.8% extra return. And now this is called overall performance evaluation. So if we check as compared to Sharpe, the highest ratio is for Z. So that is why we give number 1 to Z. The next best is market. The third is mutual fund Y, and the last rank is for mutual fund X. For Treynor, again first comes to Z, which is having 7.5 highest. This time in Treynor, the second rank we can give it to mutual fund Y. As compared to market risk, as compared to market, Y is giving extra return. So second best option is Y. Third is market, and the mutual fund X should be the last one. And Jenson, again as per Jenson, number 1 first rank is mutual fund Z, second is mutual fund Y, and the third option is mutual fund X. So as per the performance evaluation, as per the Sharpe, Treynor and Jenson's performance evaluation ranking, if we have 1 lakh rupees and if we have this past performance of these mutual funds, we should choose mutual fund X to put our hard earned 1 lakh rupees of money. So this is how we should decide. We can decide. This is one of the tools to decide our investment options. So thank you very much for the listening.